That's my hot take on euchre. Okay, we're going to dive in here. What the new tax bill means for charitable giving and what fundraisers should do next. So we, you might have understood, passed a tax bill as a country recently. We're going to dive into the ups and downs of it. And frankly, there are ups and there are downs. So we will we'll go in here. Couple of quick housekeeping notes before we get started. This event is CFRA approved for 1.0 credits. Always designated in 1.0 and not 1, which is sort of interesting to me because then it feels like you have to pluralize credits. But in any case, there is a survey at the end of the session, and you will fill out that survey, and that will help you get credit for this. So that's what that is. What is the agenda today? Here's what it looks like. We'll do intros, we'll break down the bill, we'll understand the implications for nonprofits, and we'll talk about resources, including a very cool webinar next week. So you'll get all of that. We also have a second awesome webinar being planned right now for 2 weeks from now. So maybe we'll preview that in a little bit as well. Recording and slides will be sent around later today, but someone's still going to ask about it. So do me a favor in the chat as I'm focused on this. If someone asks, just let them know that yes, indeed, those will be sent around. Intros. My name is Patrick. I am pictured here with my wonderful co-founder, Jenny. Jenny Shiao-Spradlin lives in the great city of Seattle. I live in Brooklyn, New York, although right now, as I mentioned earlier, I'm in Lake Tahoe. So it is gorgeous out here. I'm on the California side. The lake is extremely cold. It is the second deepest lake in America after Crater Lake. The woods have been great. I get to go. I've been on a lot of long hikes with my dog, and it's been awesome. Also, bananagrams is great for those of you that are checking that out. FreeWill is the #1 estate planning and plan giving solution in the United States, trusted by 2,200 plus leading nonprofits, including many of you. Thank you so much. We have been featured in such illustrious periodicals as listed here: AARP, New York Times, Wall Street Journal, Good Housekeeping, Town and Country, et cetera, and get to work with many, as I mentioned, leading organizations, ranging from our wonderful friends at the ADA, Amnesty, Greenpeace, Komen, United Way, et cetera, as well as many small organizations, churches, synagogues, mosques, hospitals, museums, colleges, schools, private schools, land trusts, animal shelters, et cetera, et cetera. And we love getting to do it. So every day we sort of we work with so many of y'all, we share your mission, we understand what you're doing, we love helping it, and it makes us really happy. We feel really blessed on a day-to-day basis. We have generated more than $12 billion for charities to date, 2,200 partners, as I mentioned, over 5 centuries of combined fundraising experience. And as you might have guessed, there is a very large team behind this. And so a lot of work has gone into everything we do, including this session. And I will shout out my colleague, Phoebe. Thanks, Trish. I just want you to know that FreeWill loves Komen as well. My colleague, Phoebe, put a ton of work and research into this and was sort of staying on top of all the sort of seesaw dynamics of the House and the Senate and what was going into the bill. And so she's been doing this research before the legislatures knew what was going in it. She was prepping all sorts of things. So huge shout out to Phoebe. LA Williams says we appreciate Phoebe, which is absolutely true. So quick background. Most of you know this, but let's just get on the same page. The House and Senate, under Republican control, introduced their own versions of the tax and spending package. Both chambers were working to extend provisions of what's called the TCJA, the 2017 Tax and Jobs Act, which was passed under the previous Trump administration, which was set to expire at the end of this year. Without an extension, more than 60% of taxpayers could have seen higher taxes in 2026, according to a 2024 report from the Tax Foundation. The House passed its version of the tax and spending bill in May. The Senate advanced its own version, which became the basis for the final legislation, trying to meet a deadline that was imposed by President Trump of July 4th. On a 51-50 vote, the Senate passed the 1,000-page bill with Vice President J.D. Vance casting the tie-breaking vote. Most of you know this, but if you don't, in the case of a 50-50 vote, the deciding vote in the Senate gets cast by the Vice President. So interesting dynamic of U.S. politics there. The bill then returned to the House and passed on Thursday, July 3rd by a very narrow margin of 2018 to 2014, just clearing the wire. And then that bill was signed into law on July 4th of 2025. So roughly 11 days ago. Now, what happened in here? There's a bunch of different things, and we're not going to cover all of it. It's a 1,000-page bill, but we have dug deep, and we're going to pull out some of the key provisions that will affect charitable giving. So first things first, beginning with tax year 2025, The SALT deduction cap rises from 10,000 to 40,000, with the benefit phasing out once AGI exceeds roughly $500,000 for a single person or $1 million for a couple. Okay, let's figure out some of the acronyms here. SALT is state, lowercase a, and lower state and local taxes. AGI is adjusted gross income, which means, hey, what's your total income roughly? SALT is property taxes, it is state sales tax, it is state income tax, most importantly. And then in some cases, like New York City, you will have local income taxes as well, although those tend to be relatively rare, except for major cities. The final bill also boosts the child tax credit to $2,200 per child, starting in 2025, indexed for inflation thereafter. Taxpayers age 65 plus, this is very important, can claim an additional $6,000 deduction each year from 25 to 28, phasing out above a $75,000 income level for a single person or $150,000 for a married couple. And that is their adjusted gross income, right? So to give you a sense there, it means that there is larger standard deductions across the board, but for seniors, there's an even larger deduction. Workers with an AGI, again, adjusted gross income, think about it generally as your income, under $150,000 can exclude up to $25,000 of tips and up to $12,500 of overtime pay, $25,000 for couples, from taxable income each year. And this break expires after 2028. So this sort of no tax on tips, no tax on overtime pledge was attempted to be met here, right? So some of you will do this. There are a bunch of different factors here in this tips area. It sort of locks in industries with customary tips before this period. So it can't be the case that you as a consultant or even a major gift officer say, okay, now pay it, like now give me tips, wink, wink, and that way I won't pay taxes on it. That's not allowed under the bill. So what else is happening? It increased the standard tax deduction. Now it permanently extends the double standard deduction from the TCJA. The deduction will be $15,750, up from $15,000 for individuals, and it will be $31,000, which is just 2x that. $31,500 for joint filers, again, mostly married couples, up from $30,000. After 2025, it will be indexed for inflation. Now, why do we talk so much about standard deductions? I mean, this is getting so wonky so quickly. We'll dive into this a bit more, but standard deductions are really important because above the standard deduction, that's when you start getting tax benefits for charitable giving. And the effect of that is that it makes charitable giving cheaper, right? So you all sort of think back to if you went to college or you did econ in high school and you had that sort of supply and demand curve. You remember that? Where at a certain price, supply increases, at a certain price, demand decreases. Well, it turns out as things get more expensive, demand decreases. And if, for instance, we're not getting tax breaks for a charitable gift, that makes functionally a charitable gift more expensive. And when things are more expensive, we know that demand decreases. So it functionally has the dynamic where a fewer tax breaks for charitable giving decrease charitable giving because, like anything else, when things become more expensive, people want less of it. Now imagine a world where every charitable gift got you a huge tax break, you would see a ton more charitable giving. And so we'll dive in there as well. Insight 2, right? So it increases, standard deduction goes up. It also increases the SALT deduction cap. So our first phase here is when the standard deduction goes up, fewer people itemize. Now, one of the big things that happened in the Tax Cuts and Jobs Act is that the state and local tax deduction got capped, which meant that if I'm paying more than $10,000 in New York State income taxes, which I haven't checked lately, but I probably am, almost certainly, I think we'll have to go check that out. But that means above that, I can't actually deduct it from my federal taxes. So there are two different things that happen here. One, it means that folks in higher tax states, like New York, New Jersey, et cetera, are paying more in taxes. So they have less money. That might increase negatively charitable giving. But it also means that it reduces the likelihood that I move into that itemized deduction world where I'm then increasing where I'm getting more benefits from charitable giving as well. After 2025, this cap will increase by 1% through 2029, and then it goes back down to 10K. So what's going to happen is there's going to be a lot of pressure in 2029 to pass a new legislative shift to get this as well. So what does it mean? It means New York, California, New Jersey, the number of folks who are itemizing deductions here, especially up to that $500,000 income level, are they're more likely to be above the standard deduction and itemizing, which has more benefits for charitable giving. Now, it starts to phase out after $500,000, et cetera, et cetera. But the more, if you're making more than $500,000, the more likely you are to be in the itemization category anyway. Now, there's a quirk here. Now, this is a really good thing generally. So for non-itemizers, now historically we've said non-itemizers are sort of screwed lately because they don't get a tax benefit for charitable giving. And there was enough groundswell of concern for nonprofits, or at least some nonprofits, in Congress that for the first time since 21, non-itemizers will permanently get a tax break for charitable giving. Now, the 2021 tax break was pretty small. I actually don't recall the number. Maybe some of you do. But I think it's like $300 for an individual, $600 for a couple. If anyone knows that, feel free to add that to the chat. But in 26, thank you. Nicole says 300, 600. Nailed it. Feel good about that. Okay. In 26, it's up to 1,000 for individuals and up to 2,000 for couples who don't itemize. So these are your small dollar donors who will suddenly get their tax breaks back up to $2,000 in charitable giving. So if you have someone making $60,000 a year, $2,000, pretty big tax gift, right? Pretty big gift as a percentage of their overall giving. So you'll start to see more benefits for small donors. We have been in a cyclical decline of small dollar donors, and maybe there's some hope that this is going to help out in 2026. What this doesn't help is that sort of like early mid-tier, just above that $2,000 level. This is considered an above-the-line deduction, meaning you can claim it even if you take the standard deduction. So that's what we mean by non-itemizers, right? We say, okay, the standard deduction is bigger than all the items that I would add up to, so I'm just going to take the standard deduction. And then above that, I get this little $1,000, $2,000 tax benefit. This is pretty good. Now, it doesn't mean I get $1,000 back. It means if I give $1,000, I write that off of my taxes, I take that out of my income, and what do I get back? Maybe $300. But suddenly, it's basically a 30% off coupon on my charitable giving. And again, let's go back to our supply and demand curves. As that gets cheaper, my willingness to give goes up, right? So very, very interesting as well. Now, Maria says, and I think this is really important, it's going to be hard to recapture small donors when the cost of everything is going up. And this is right. So this is sort of an all things being equal approach. But if things get wildly expensive in the world because of tariffs or because of other things, yes, inflation is going to hurt small dollar donors nonetheless. This does create a charitable giving incentive for the 90% of taxpayers who currently actually have no tax incentive to give, right? 90% of Americans don't itemize their taxes right now. So this is a big win, right? All things being equal. Now, there's other things in the bill that aren't great, but this particular element is quite helpful. And we'll talk more as we get into later in this year and we start prepping for 2026. We'll dive more into specific language that you can use to capture some of these 1 to 2,000, right? But what it means, by the way, is that 1 or 2,000, after that, these folks aren't getting any benefit until they go even further up and start itemizing. And so there's actually going to be a little bit of a race among charities to get that first 1,000 or 2,000 as well. All right, so we're going to dive in more on some of the other charitable giving deductions in a moment. But first, there's a new tiered tax on university endowments. This will affect some of you, but almost relatively small percentage here. Starting in 2026, new federal taxes will apply to the investment income of certain private colleges and universities. The tax applied to schools with more than 3,000 tuition-paying students and high endowment levels per student, right? So think about your Harvards, your Yales, your Princetons, your Dukes, your Notre Dames, your Georgetowns, your Stanfords. These are largely private schools, although not entirely. The tax rate depends on how much the school has per student. So you might actually see some interesting dynamics here. Are schools going to try to increase the number of students to avoid the taxes here, right? So that's interesting as well. It's 1.4% if the assets per student are between 500,000 and 750,000, which is quite a lot. 4% if between 750 and 2 million, and 8% if over 2 million per student, right? These are excise taxes, which means taxes on the gains of endowments, right? So it's not that 8% of the endowment gets paid. It's as that endowment increases and you're selling positions, the same way that you pay capital gains taxes, that's where that goes. This again won't apply to schools with fewer than 3,000 and only to endowments exceeding 500K per student. So smaller colleges will likely not be affected here as well. The net here, by the way, I think the analysis was that this is going to raise something like $5 billion over a 10-year period. Now that sounds like a lot. It's actually 500 million per year. It's going to play a relatively small role. That's across all endowments. This is going to be annoying for colleges. It's not going to be catastrophic as well. I believe it only applies to private schools, and I believe that some religious institutions are excluded, but someone who has access to live Googling right now can fact check us on that. That would be very helpful. Insight 5, as we mentioned, TCJA becomes permanent. It doubled the standard deduction. It itemized deductions for state and local taxes to 10K per year. It also capped the mortgage interest deduction. Now, why is that important? Again, we're getting really wonky in mortgage interest deduction tax savings. Well, it turns out that mortgage interest and what else? State and local taxes are the number one things that push people into itemization territory. So for mortgages taken out after December 15th, 2017, interest is deductible up to $750,000 of mortgage debt and $375K for married filing separately. Now, what else matters in whether mortgages kick people into this itemization territory? Well, interest rates, right? So a 2% mortgage, which some people are getting, or a 3% mortgage, what they call a 3 handle, which means it starts with 3 handle in 2019 when that was still happening, versus a 6 handle now. Now that's a lot more likely to be serious interest, which is kicking people into high deduction territory. So most taxpayers over the last 8 years have gotten bigger tax breaks from taking the standard deduction than they do from itemizing deductions like charitable contributions, but of course, many other things. The result is that in this year, 10% of Americans now itemize deductions, down from 30% pre-TCJ. That is a huge shift. It's an enormous shift. And it wasn't a good thing for charitable giving, right? It actually meant that many of those folks were paying less taxes. But a study by Indiana University and the University of Notre Dame found that charitable giving fell by $16 billion annually in TCJ's first year of implementation. So really interesting dynamic there as well. This is what the research said. It said the 2017 Tax Cuts and Jobs Act is the largest change in US tax policy in a generation. And our research shows that it has a large effect on charitable giving, Otani Wilhelm said, who's one of the lead researchers here. Among households that have previously been itemizing but switched to taking the standard deduction, which is really what we want to see. If you've already been standard deduction or you've already been itemizing and you're still itemizing, that doesn't matter. But that switching group matters. The amount they gave to charity decreased by an average of $880. Now, this $880 is interesting because what does it mean? Well, we know that now we're getting $1,000 or $2,000 back in tax savings. So the proof will be in the pudding, but you may see a little bit of a shift in this dynamic as long as charities, like all of us, are messaging this appropriately. So very, very interesting. Now, let's just take a quick look. How many people were itemizing? I mean, this is remarkable, right? Itemizing in 2017, itemizing in 2018, itemizing in 2022. We went from about call that 47 million to 17 million to just a hair over 15 million. I mean, these are really big shifts across the board. Now, how much of that is claiming charitable deductions? Well, you see it's very similar, right? So the people itemizing itemizing deductions, those are the people itemizing charitable giving, and you see a relatively strong portion of that as well. So very interesting to see. Now, total amount of charitable deductions. Now, this is interesting, right? Now, you would have thought it went down. Oops, let's go back. You would have thought based on this number, this is the number of charitable deductions. This is the dollars of charitable deductions. You would have thought, boy, that number is going to go down just because the number of charitable deductions is going down. But in fact, what's happening is that your big donors are giving more and more, and your small donors are giving less. So this is a really interesting dynamic. You saw that bounce back in 22. Be interesting to see what that looks like across the board. Now, 6, we talked about this earlier, but I want to come back to this. Okay. President Trump campaigned on no taxes on Social Security. Congress said, that's going to be really hard. But what we're going to do instead is we're going to add an additional $6,000 standard deduction for taxpayers who are 65 and over. According to NPR, quote, those who see the biggest benefit are those with incomes between 80,000 and 130,000. They should receive an average tax cut of $1,100. Lower income seniors won't notice any change from this deduction because they already earn too little to pay taxes. And higher income folks won't see a change because individuals with incomes over 175 or couples over 250 won't qualify for the new deduction, right? So this is a really focus on middle class seniors. Now, some of you might know this. There was already a little bonus standard deduction for seniors. This is on top of that, in case you were wondering. This means that even fewer seniors, especially those in lower tax states, will be itemizing deductions in the future. Seniors will be hunting for other ways to save on taxes when giving. Now, why does this matter? Seniors, 65%, not a huge portion of the population. Well, first, wrong, a rapidly growing portion of the population. But then when we asked you in a previous webinar, what percent of your donor base is over 65? I mean, take a look at this. 40% of you say 51 to 75% of our entire donor base is over 65. And 15% of you say 3/4 to all of our donor base is over 75. So we have to really pay attention to how tax policy is affecting folks over 65. And what it means is you're going to have even fewer senior itemizers, especially when you're outside of the property tax paying high states. So this is really interesting as well. Now, what percentage of revenue comes from folks over 65? And we saw numbers like this, right? So, let's go back. Sorry, clicking around here. 21% say at least 3/4 comes from these group, and 44% say between half and 3/4. So really interesting dynamics as well. All right, insight 7, corporate giving. Oof, rough day for corporate giving. So there's a new 1% floor. So C Corps, which is what most of the companies that you know about, publicly traded companies, these are not law firms, they're not sort of solo consultancies, et cetera. C Corps can deduct only the portion of charitable gifts that exceed 1% of taxable income. This is effective for tax years starting Jan 1, 2026. The revenue effect is that we may see a $4 to $5 billion annual drop in corporate giving. This is a lot, right? What's going to happen for large, highly profitable firms that already give more than 1%? They're probably not going to change much. Google, right? Microsoft, Walmart, they give a lot of money here. But a small company or a low margin company where they're giving routine community gifts, and boy, those tax benefits are quite helpful, those might see some shrinking and likely shrinking CSR budgets because, again, for companies, charitable giving now became more expensive. Let's go back to our supply and demand curve. What happens when things get more expensive? People tend to do less of them. CSR, says Brandon Boyd. What does CSR mean? CSR means corporate social responsibility. So a lot of companies have a corporate social responsibility office or person who's in charge of at least making some contributions to the community. Obviously, a lot of this is sort of general marketing and not necessarily maximizing impact, but still nice to have. We'll see that. So what's going to happen here? The first thing is that corporations may bundle pledges. They might say, we're going to give all of our money up front, or we're going to give it all next year in order to clear that 1% floor instead of just missing it every year, right? It's better to give 3 times in 1 year and then nothing in the subsequent years from a tax perspective than giving it all evenly. Now, nonprofits should say, okay, who do we think is giving more than 1%? Let's keep focusing on that. And then for the smaller organizations, your small businesses, really refocus this as marketing or brand value and the benefits to them as opposed to tax savings, because a lot of these folks will be getting tax savings next year. So we're going to have to rethink some of our corporate strategies as well. Now, what does this mean for charitable giving? Let's dive in a little bit more. First is there's a greater incentive for small dollar donors, right? The universal charitable deduction gives your small dollar donors a straightforward tax benefit, even if they don't itemize. Again, I mentioned this, but it's $1,000 in cash, up to $2,000 for couples. This applies to all charitable donations made during the calendar year. right? So really, really good, right? And you will see, hopefully, some increase in the folks that are giving you 10 or 20 bucks right now. Where does this level off? So while this may be good for broadening overall giving, it's likely to increase the number of people who are giving. It might limit how much donors choose to give. Because for non-itemizers, once they hit that 1K cap, there's no additional tax benefit to giving more. Some donors may choose to pause or reduce their giving once they've hit the limit. A loyal monthly donor giving $100 a month or $1,200 a year might reduce their gift to $85 a month to stay within the cap, knowing the extra $15 is no longer tax deductible. And without further incentive, donors might feel unmotivated to increase their giving over time over that $1,000 or $2,000 number. Now, of course, this does not apply to non-cash gifts, so we'll talk more about this in a moment. But there's a hack here for donors that a lot of donors are already shifting to in order to generate more tax savings. So what about itemizers? Well, there's the good news for non-itemizers and bad news for itemizers. So itemizers now face a 0.5% giving floor, a decrease from the 1% giving included in previous versions of the bill, but still a 0.5% giving floor is a problem. Donors who itemize can only deduct charitable gifts that exceed 0.5% of their adjusted gross income. Now, 0.5% is actually quite a bit of money. And so it's making for an itemizer, the early gifts become more expensive and the later gifts become less expensive. For the non-itemizers, the early gifts become cheaper and the later gifts become more expensive. So it's a really interesting dance here. For example, someone earning $100,000 a year must give more than $500 before they receive any tax benefit at all. So this is an important shift and not necessarily a good one. This is a new rule, so we'll have to wait to see how donors respond. But mid-level donors may be most affected since they would need to increase their giving to qualify for a tax break. To work around this, some donors may start bunching their gifts to charities or to donor advised funds. So you're likely to see a bunch of donor advised fund gifts as folks try to push over, right, that 0.5% in one year and then maybe dole it out in subsequent years out of a donor advised fund. Now, quick note here that above the line deduction for non-itemizers, and I know there's a lot going on here, but non-itemizers can't give to a donor advised fund. So you can't say, I'm sending $1,000 to a DAF, I'm writing that off. So interesting dynamics there as well. So it might mean what's happening is giving more in the first year and then skipping the following year. So what should we do about this? There's a lot going on. What should we as charitable fundraisers do differently going forward based on the way the world is changing? So the first thing to know is that we think non-cash gifts are more important than ever. The universal cap for standard deduction donors weakens the incentive for any donor to give cash. Once a donor hits their $1,000 cap, any additional cash gifts may give them no tax benefit. Non-cash gifts like stock, qualified charitable distributions, which are only for seniors, we'll talk more about that in a moment, those are going to be really important. So sort of lock your brain onto the qualified charitable distributions term. And donor advised funds offer additional tax benefits even to non-itemizers. So we want to keep promoting these gifts. Now, we won't go through every benefit of each of these gifts, but suffice to say that you basically avoid capital gains taxes while also getting income tax deductions for these gifts. And so this can be quite valuable. Strategy 2, donor advised fund gifts as an alternative. So donors who itemize may not receive any tax benefit unless their giving exceeds more than 0.5%. So what's going to happen is a donor advised fund is going to say, why don't you put a bunch of money in here in year 1 and then gradually give it out over years 2 and 3. So let's say, again, I'm making $100,000 a year and I want to give $500 a year, right? What I'm going to do, if I give $500 year 1, $500 year 2, $500 year 3, what do I get is no tax benefit. If I put $1,500 in a donor advised fund in the first year, I get $1,000 of tax benefit because, right, we don't get anything for the first 500. And then in year 1, year 2, and year 3, I actually send $500 out. Excuse me, my dog is making some noise because he's excited about this as well. So then what we do is we start giving that out over 3 years and you have the same impact with more tax savings. So what's going to happen is a lot of financial advisors are going to walk their clients through this strategy and put more money into donor advised funds. Promoting DAFs throughout the year, as you might have guessed, helps donors plan ahead for year-end tax savings and making more strategic gifts. People say, show us the dog. Let's see. Can we get you in here? Brooklyn, you want to say hi? I'm going to have to bend this monitor. Can you, come on, where are you? Down there. Oops, there he is. All right. A little showing. Now we've already messed this up. We'll get a picture next time. He's not good at posing for video. But we'll okay, next time we'll there's a lot of demand for Brooklyn content, so good to know. Next time we'll bring some pictures. All right, back to this. Everyone refocus, including me. So what's going to happen is you're going to want to promote DAFs throughout the year to help donors plan ahead, and there's some other options as well. Now, the other thing to know about donor advised funds is that the S&P 500 is up 6% year to date as of yesterday. It is up 11% over the past 12 months, which is a very strong 12 months, and it is up 94% over the past 5 years. So there's two real things that matter for donor advised funds. How good is the stock market going, and what is the tax policy? And so the market performance combined with increased incentives to bundle giving should increase the amount of money in DAFs and should make those more important. You can also suggest that donors make a multi-year gift up front. So if you are a major gift officer, what you should be doing over the next 6 months, or you may see more giving. This, by the way, takes effect next year. So you might say, do you want to give more this year instead of next year if you're not going to hit that threshold, right? And you give your 2-year gift up front. Or you can talk about getting upfront gifts and sort of 3-year gifts up front. Now, this is going to create some waviness in your numbers, but from an impact standpoint, you should be able to plan more effectively across the board. Strategy 3, as I talked about earlier, let's prioritize qualified charitable distributions from older donors. QCDs, these are gifts from an IRA, are not impacted by the floor on the deduction cap for cash donations, right? So what happens here is that QCDs offer donors age 70 and a half and older a direct way to give from their IRA without increasing their taxable income. So let's say I'm a non-itemizer. The first money should definitely be out of my IRA. That will save me taxes. By the way, I can still give that $1,000 cash gift out of my account, get the tax saving there, and do an additional $2,000 or $3,000 out of my IRA, and that will give me tax savings across the board, right? You have to be 70.5. That's sort of an annoying facet of the legislation, but you have to be that old in order to do this. For donors subject to required minimum distributions, which I believe is at the age of 73, again, someone can fact check me on that. QCDs help reduce the adjusted gross income because what the government says is this money went in pre-tax and you have to take it out and you have to pay taxes on it. By the way, if I pass away with an IRA, my heirs pay taxes on that, even if I'm below the estate tax threshold. So QCDs are an incredibly important way for tax savings and a great way to give. Unlike cash gifts, QCDs don't need to be itemized, as I mentioned, making them especially valuable under the new tax law. Thank you so much. Everyone says 73 is, so 70 and a half is when you can start giving money out of your IRA with these tax savings. And 73 is when you have to take money out of your IRA, but you can satisfy that with the qualified charitable distributions. So it's very, very important. Yeah, Kathy makes a great point. She says a very common misconception is the QCD age is tied to RMDs, which is not correct. You can give an RMD starting at 70 and a half. Oh, and by the way, there are something like 10,000 people turning 70 and a half every day in the United States because of the baby boom and the demographic wave. And so if you're not smart about this yet, get smart about this very quickly. We want to promote QCDs as a penalty-free workaround for donors who feel boxed in by the new limits on deductions. It is a great thing for you to be educating folks on. So anyone over 70 with educational outreach, that says HAT explains how to give a QCD. I think that's my typo and not Phoebe's. It should say that explains how to give a QCD. Include QCD options in your ways to give page and donate page, and add a call out on appeals like, are you 70 and a half and older? Give directly from your IRA to maximize your impact and minimize your taxes. And then a link to your page about QCD giving. Now, some of you might say, well, I don't know who's over 70. Well, when we went back to that survey, you told me that more than half, and in some cases more than 3/4 of your donors are over 65. So it's a safe bet to include this without saying you are 70 and a half, right? You can say, just in case you're older. And by the way, a lot of those folks are 68 and will be turning 70 and a half in a couple of years. And now they're going to have this sort of pre-priming for that kind of gift. So great question. We asked you, in the past 5 years, has your nonprofit seen an increase in QCDs? And what you can see here is 18% said a big increase, 52% said a smaller increase, the rest said no change, and 0 people said a decline, right? So this is only going one direction. Why is it only going one direction? 1, tax policy, 2, demographics, right? So these things both matter a lot. Really, really important. Bonus tip. So we have done a ton of research on effective QCD fundraising over the years. And what we've seen is that you want to promote them more widely in your marketing materials throughout the year. So this is not, I repeat, this is not a wait until end of year giving. Most of the giving does happen towards end of the year, but if you wait until then, you'll miss out. Now, the 2021 QCD report that FreeWill published found that folks who promoted QCDs 3 times or more over the course of a year saw a huge boost in QCD giving at end of year, right? So you lay the seeds early and then you harvest it late. Now, what's one other reason why you would want to front load QCDs here as well? Anyone want to think about why you want to get ahead in the year on QCDs? Let me know if you have any ideas in that. Taxes, estate gifts. Iman is correct. Required minimum distributions, right? And Laura says, so that people don't take their RMD. So if you are over 73, remember, you have to take some money out of your IRA every year. There's a special calculation that says, how old are you? Okay, based on that, this is the percentage you have to take. You could have 10 million in your IRA, you got to take that percentage. You could have $10 in your IRA, you got to take that percentage. But if I take that out in March, then the QCD no longer satisfies my RMD and I've missed the boat there, right? So that's why we want to get ahead of folks taking out their RMD as well. One thing we do, it's not in the slides, but one thing we suggest sometimes is when you have previous QCD donors, folks that gave you last year, the year before, think about when did they give, because their financial cycles are likely to be locked in. And get ahead of that 2 months in advance and say, let me go ask for a QCD 2 months before the time they gave last year. So if it's an April or May QCD, maybe in February and March, I'm reaching out, right? So that's just a little tip that you can use, but people tend to be pretty predictable, especially as they get older, right? So Margie says RMDs are a nuisance for many donors. They don't want it. So there are a lot of folks who are wealthier who say, oh, I don't need this money because, boy, my investments have gone so well. I don't want to be forced to take this money out and now I have to pay taxes on it. And then you show up and say, did you know about QCDs? It is an incredible way to make charitable gifts. Okay, so we're going to pause there because I want to leave some time for questions. And so feel free to add them in the chat or put them in the Q&A if you have any questions now. And my colleague Phoebe, while we sort of pause for people to have questions, just put a survey in the chat. So take 10 seconds now, click it, and do that as well. So a couple quick things here. For this Thursday, which is July 17th, we are doing a special webinar hosted by our dear friend, Dr. Russell James. So many of you know Dr. J. This is specifically focused on faith-based organizations. So Dr. James is the leading academic in overall planned giving and major giving. He's just brilliant and works and supports virtually every type of sort of smallish and medium up, right, in term organization. And many of you have learned a ton from Dr. James, as have I. He also, by the way, used to run a Christian college. I mean, many people don't know this. And I think maybe was an ordained minister at some point, still is. I'm not sure. I could be making that up. But anyway, so his newest book is specifically about Christian fundraising. So just to sort of set expectations there, this will be very sort of biblically focused compared to a lot of the learnings you do. For some of you, that will be super helpful. For some of you, that might not be as well. So, but in any case, you're welcome to join this regardless of the focus of your work. And that is at noon in 2 days. So please, please, please. We're going to do some Q&A. And then the last thing I want to say here is that next week, now that we have a little more information about the tax bill, which, by the way, affects this calendar year in some ways, right? There are some elements of the bill that affect 2025, which is sort of wild. Usually tax bills affect 2026. But there's a bunch of different factors here, right? So there's political dynamics, there's economic dynamics, there's the market, there's what we're seeing from donors, there's technological advances, et cetera, et cetera. So we're going to dive in. I know it's too early to talk about the holidays and end of year. But as a fundraiser, you need to start prepping now. So we are going to talk about some steps that every nonprofit should take for a standout end of year in 2022. And then lastly, I will say, if you have anything you want to, if you have anything to share or questions, you can find me on LinkedIn, super easy there. And you can always reach me on email. So we'll do a couple minutes of questions, probably not go all the way to 1 o'clock, but we'll do 5 or 6 minutes of questions, and then we'll go from there. So I'm just going to pull these up if you don't mind. If you have other questions, please put them in the Q&A. Oh boy. Okay, we actually have a remarkable number of dog questions. So dog's name is Brooklyn. Brooklyn is an Alaskan Kleekai. Kleekai is a mini husky. He is 12 years old. He will be 13 on Halloween, and he is lovely. He's a fun dog. So we'll get more pictures there. Thank you for asking. Great question. How do tax deductions for married couples work if one person is over 65, but the other person is not? I believe, I could be wrong here, that you get a $6,000 deduction additional for each person over 65. So if you're filing jointly and one, husband is 67, wife is 63, or vice versa, what will end up being is that you get a 6,000, and then when the other spouse turns 65, you get to 12,000. So great percent. Is the 1% floor for corporate the max or minimum amount to give? So Jolene, the 1% floor means that if FreeWill gives away a percentage of its net income, which means how much money we make, up to 1%, we can give, the government says you can give as much as you want to, right? From a tax perspective, the first 1% we give has no tax benefit. After that, everything from 1% to 100% of all of our income has a tax benefit. So that will give you a sense of that. What research is there exploring which donors are motivated by tax incentive to compare to other factors, emotion, affinity, narrative, guilt, fear, loyalty, relationships, etc.? Now, there are two different ways to think about this. One is, what do people say they are motivated by versus how are people actually motivated in practice? So the research shows that small dollar donors report not being motivated by tax savings, but in practice, you do see a reduction when people move from standard deduction to itemizations. Now, sometimes people are giving anyway, but the amount that they give. Major donors are also heavily affected by tax strategies. If you can say, look, you can give this way and save this much money on taxes, it's not that they wouldn't have given otherwise, but they're likely to give significantly more. So one of the rules we always say is, if you want to raise your revenue as a nonprofit fundraising team, your first step is to get larger gifts from the same donors, right? That is a faster path than increasing your overall donor base. The second thing we say is that the fastest way to get larger gifts from the same people is not to just do an incredible job stewarding them, although you should do that as well. It's to change the way they give. So if we can get people to move from cash gifts to non-cash gifts, you'll often see a 10 times increase in giving from the same people. That's why it's so important to move from cash to QCDs, from cash to stock giving, from cash to donor advised funds, right? From cash to crypto in some cases, right? All these will result in much larger gifts for lots of reasons that we've covered elsewhere. Why can't non-itemizers write off DAF gifts? It says Natasha. Natasha, the answer is sort of because they can't, right? It's just the way the legislation is written. The gifts to donor advised funds do not get that special above the line treatment. So I don't have full background into what discussion went into that plan, but that's just the way the law works. So that could be good. Wade says, Wade's question is basically, can you clarify what itemization means? So just to recap this, there are different things that will reduce your taxes, right? Paying state and local taxes, paying mortgage interest. Now, car payments, right? Interest on car loans this might not be a good idea, but it's true anyway. Interest on car loans is now tax deductible. And these things start to stack. And in the meantime, there's a standard deduction. So if your stack doesn't get above the standard deduction, doesn't matter. You take the standard deduction and you get sort of a reduction of your tax bill in that degree. If you get $1, if your stack gets $1 above the standard deduction, suddenly you're an itemizer and all these things matter. And then you keep itemizing. And as it gets bigger than that standard deduction stack, that's when you start to have more tax savings. So that's what it means, right? So yes, it's charitable contributions, but typically the biggest things that go into the stack are state and local taxes and mortgage interest. So great question. Rachel says, an article just came out that Donald Trump will potentially end capital gains tax, and then links to it. Does FreeWill have a forecast of what would happen if he does? This is the first I'm hearing about it, and I would be stunned if this went through. Why is that? Capital gains tax, there's two reasons why you would oppose this. One is it's a lot of revenue for the government. So you'd have to cut an enormous amount of spending if you got rid of capital gains taxes. And I don't think the Senate or the House has a stomach to do that. The second is capital gains taxes, cutting capital gains taxes would be extremely regressive as opposed to progressive. Why is that? Capital gains are taxes paid on investment growth. Now, the people that have more investments and hence more investment growth tend to be a lot wealthier than the people who just make income. So the fact that capital gains are already lower than most income taxes is a problem in the United States. But from a working class supporter base or sort of general working class America, it puts a deeply unfair tax burden on working people compared to the investor class. And so my guess is you would have widespread opposition to this. Now, you know, whatever you think of the Trump administration, I think we can all agree that they tend to float things that may not be serious, and you have to sort of wait and see as to see whether that will be. Evan says, were there any changes or increases to the life income gift options funded by QCD? No, there were no changes as far as I can tell in this tax bill. We can reread the 1,000 pages, but that is a good question. Okay, let's do the last question. Jim says, any language recommendations for calling a donor about giving them from a QCD again this year, 2 months beforehand? This can be awkward sometimes if we've never spoken to the donor. So here's what I would say. Jim, if I were to call, Jim, I don't know how old you are, but let's presume you're 75, which you're probably not. Jim, I'm calling you and here's what I would say. I would say, Jim, like, first of all, I was looking at our records and last April, you made a qualified charitable distribution for $2,000. And I know you got our thank you note in the mail and we want to do that, but I wanted to actually reach out and just tell you how that money got put to use. And Jim, I don't know your organization, but let's say that you're a land trust outside of Houston. That money contributed to this project, which 3,000 people have bid on and experienced nature in a way they might not have otherwise been able to. And this many kids got to participate in our butterfly witness, project where they got to see these things, fly for the first time, whatever it may be. And so, thank you. I just want to make sure you knew the impact you were having. In case you're interested in QCDs again, I want to share a little bit of information about how the tax bill might make that thing you did last time even more beneficial this year, just so you know about it. And as an aside, some language I love to use is, I think this will be helpful for you in any of your giving to our organization or anywhere else, right? Because it means that we're offering educational value and not just asking for something. And a lot of folks that are giving to you are also giving to their church. They're also giving to their synagogue. They're also giving to their college, right? They're giving to their kids' private school. They're giving to the local museum. They're giving to the land trust. And you're not the only recipient, right? Very few of your donors are only giving to you. And so when you can educate someone for any of their giving, it creates lots of amazing opportunities. All right, so we're going to pause here, and we are going to bring a lot of these questions this next week's session. So what should we actually do about this for end of year? And so I just want to say quick shout out again to Phoebe, who put a ton of work and research into this, as well as the rest of the FreeWill team. So big thank you, Phoebe. Really, really appreciate it. And to everyone else, like this is a lot to deal with. And so thank you for coming and joining and learning about this with open ears. I promise you more dog photos next time, so we don't have to sort of wrestle the monitor. And yeah, have a wonderful weekend. Hopefully, some of you are getting some time off this summer, getting outside. Hopefully, it's not too hot where you are. And we will send the recording of the slides around later today. And we cannot wait to see you next week. So thank you one more time.